Good morning and welcome to our discussion on principles of economics. Today we are going to talk about a very interesting and important topic which is money and monetary system. If you recall when we started our discussion we said that before studying economics in detail we used to think that economics is all about money, right? Yes, economics uh, is not all about money, but money plays an important role in the economic discipline. But you see, we are discussing about money only at the end. So it requires some amount of understanding of your uh, principles, so basic principles to understand what is money and monetary system. So when we think about money, generally we the idea or the notion that comes to our mind is basically money is nothing but that currency note what we usually use to purchase goods and services. But the idea of money actually in economics is much broader than one piece of paper or the currency note what we generally think about. Let us see what is money all about. Look at this. Money is a set of assets. So that means when I say set of assets, that means one thing is very clear. Money does not imply only one piece of paper, right? It's a set of assets in an economy that people regularly use to buy goods and services from other people, right? So when I say set of assets, that means money is basically assets, but we will see not all assets are not money because not all the assets are used to buy goods and services, right? We have some specific assets which we generally use. So asset or wealth, uh, not all type of wealth or assets. For example, if you have a 3 BHK house, that is an asset or wealth. But can you use that asset or building to buy 5 kgs of rice? No, right? So that means not all the assets are used to buy goods and services, and that is why money actually is a medium of exchange that we have to keep in mind. If some asset is used as a medium of exchange, then only we can call that asset as money. So, what are the functions that money uh, plays? First of all, the medium of exchange, as I said. Interestingly, let's say you are into a restaurant and you had a nice lunch. After having the lunch, what you pay to the restaurant owner? Only a piece of paper, right? 500,000 or 2000 rupees. That means a piece of paper. Have you ever thought that the restaurant owner has given you so much of food which was really valuable to you, but you have given only a piece of paper and restaurant owner is very happy with that? Why this is so? We have never thought about that, right? Now, to understand why the restaurant owner is happy with that piece of paper, let us assume that there is no money in the economy. Then what you should have done when you had lunch in that restaurant owner has given you something valuable to you. So in return, you should have also paid something to the restaurant owner which should be useful or valuable to the restaurant owner. So what you should have provided in return? Probably you should have washed all these vessels and dishes for the restaurant owner. Or you should have cut some vegetables for the restaurant owner. Or you should have provided some interesting recipe to the restaurant owner so that next day morning the restaurant owner could have used that recipe to prepare some kind of breakfast, lunch, or dinner. So these are the certain things that you should have provided in return to the restaurant owner had there not been any amount, any money concept in the economy. Okay, now money makes life simple. You don't have to wash dishes after having lunch in the restaurant. Neither you don't have to clean the car of the restaurant owner after having lunch. In return, rather, what you are doing, you are giving a piece of paper, because the restaurant owner knows that this piece of paper, the restaurant owner can also give it to a third person, from which the restaurant owner might be getting something which is valuable to him. For example, the restaurant owner can buy vegetables, can buy fishes, mutton, chicken. The restaurant owner can pay its chefs, so on and so forth. And those people are also happy in taking that piece of paper from the restaurant owner, because they can also exchange that piece of paper to a fourth person, from which they will get something which is valuable. That means the money plays an important role in an economy which is called medium of exchange. And in absence of money, life would be miserable, because for any transaction to happen, there should be a double coincidence. For example, let's say I have some money, I have some banana. As a farmer, I have some banana, and I would like to exchange that banana to have some kind of rice. On the other hand, the rice grower has rice, but he also should require banana. Let's say that rice owner needs some amount of apple instead of banana. So that means transaction will not happen between the banana person who has banana and the rice grower. So there should be a double coincidence. So the other party should have the rice and should be willing to take banana in return. Banana owner should have a need for the rice. So that is why this is called double coincidence. So I need something which you have something which I need in return. Then only there will be a transaction or exchange possible, right? So money makes the life simple. So we should not have, if there is no double coincidence, money can be used as a medium of exchange. So that is the first rule. Then account. Unit of account. For example, when I keep all my assets in bank, so I would like to know how much asset I have. So either in terms of thousand or lakhs or crore. So that means crores of money means I have this much of asset. I can use that money as a unit of account. And then as a store value, right? When I deposit my assets, I can have a store value. Unit of account you can think of, let's say I have a pen, and then what is the price of that pen? Can I say that the price of the pen, when I'm saying 10 rupees, that means money is used at a yardstick or unit of account, right? So let's say that one pen costs 20 rupees, one banana costs 4 rupees. That means one pen is equivalent to 4 bananas. So can we say that the price of the pen is 4 bananas? No. Or can I say that the price of one banana is 1/5 of the pen? Do we express the price of items in this way? No, that would be absurd. So that's why money is also used as a yardstick or unit of account. So as a medium of exchange, so a medium of exchange is basically is an item that buyers give to sellers when they want to purchase goods and services. When I buy goods and services from a shopkeeper, what I give? I give one piece of paper. Or sometimes I can write one check also if I don't have. For example, when we go to the car showroom to buy vehicles, we don't pay that much in cash, right? Rather, we buy a check. So that is also another form of money only, which is called some kind of check. That means I am giving you some kind of access of my account. If you go to the bank and put the check, the bank will give you money. Okay. So medium of exchange is anything that is readily acceptable. So the uh, if it is not readily acceptable, then it is not a medium of exchange. As I told you, that it should be readily acceptable by others. So that's why not all assets are considered as medium of exchange. Only certain units are certain assets. So unit of account, as I said, a yardstick. People used to post prices. Like I said that the price of the pen is 20 rupees. Okay, or price of the shirt is 2000 rupees in that. And store value means a store value is an item that people can use to transfer purchasing power from present to future. Okay, so I keep my assets in bank. That means I can use my present consumption to the future consumption. So store value. So these are the three functions that money has. Then it comes the liquidity. So liquidity is basically the ease with which an asset can be converted into economics medium of exchange. For example, when I'm saying gold is an asset, and gold can also be converted into money very easily. That's why the currency note, this is the most liquid money that the economy has. We can exchange that money very easily with others. Others will also accept. The next item is gold. Okay, gold can also be converted into money quickly. But suppose you have a stock or you have a bond that is not easily converted to money. For example, when I go to a market, I cannot give one stock or one share of a company and say that give me one bag of rice. Very difficult. Okay, so we have to keep in mind the ease with which the other assets can be converted into a medium economics medium of exchange, that is money currency, is called liquidity. Okay, so there are different types of money. First one is commodity money. It takes the form of commodity with intrinsic value. For example, gold, silver, and look at the third item, cigarettes. How can cigarettes be considered as money? Yes, we have taken this example because during the time of Second World War, what used to happen, the prisoners inside the prison, what they used to do, they used to use cigarettes as a medium of exchange, and that was well accepted by others. So that's why even the non-smoker also used to take cigarettes from others, knowing that he will exchange these cigarettes to somebody else, and in return that person will give you something useful to the cigarette owner. So that's why you can understand that commodity money means it has some kind of intrinsic value. Both, all these items, gold, silver, cigarette, they have intrinsic value. That is why it is called commodity money. Next one is fiat money, very important and interesting. What is fiat? Fiat is basically a decree, okay? A decree or given by the government. See, when we use that currency note, 20 rupees, 10 rupees, 500 rupees, or even 2000 rupees, what we use is a piece of paper. It doesn't have any intrinsic value, but then why the other people are accepting it? Because the government has given some kind of decree or promise along with 2000 rupees note. In the bottom part of that money or that currency, it is written that I promise to pay the bearer the sum of 500 rupees. That is a decree or promise. So if you go to the Central Bank of India, which is the RBI, you will get that 500 rupees worth of commodity, let's say gold or silver or anything. So that means there is a promise given by Indian Central Bank, and the governor's signature is also there. So that means the RBI governor is actually giving a promise that pay, I promise to pay the bearer the sum of 500 rupees. That promise is valuable, not the piece of paper. So you can get another valuable piece of paper, okay, but still that is not valuable because there is no promise. It is not that the paper with which these currency notes are made, they are the most valuable. No, you might get other valuable piece of papers, but those are not valuable because no one has given any decree against that piece of paper. That is why fiat money is the money which we see in and around, but it doesn't have an intrinsic value. It has only the government's promise. So coins, currency notes, and check deposit. So check paper, check deposits also. What I am giving when I am writing a check, I am also again giving a piece of paper only. It doesn't have any intrinsic value. But why it is valuable? Because I am giving a promise. If you show that check to the bank, bank will give you money, and with that you can buy many other useful items. That is called fiat money. And then in the US economy or even in the Indian economy also same thing. Currency is basically is the paper bills or coins that in the hands of public. What we get, the paper notes or coins, these are called currency. Rupee in Indian context, dollar in the context of the US. Okay, then we have demand deposits. Demand deposits are the basically balance in our account. So if you look at your checkbook, then whatever money you have deposited, there will be a figure. Okay, so using that demand deposit, you can actually write checks. So currency and demand deposit, these are the two major sources of money. Look at this diagram. So there are, sorry, look at this. Basically two types of money. Look at this, M1 and M2. M1 is basically demand deposit, checks, traveler checks and currency. And M2 is basically saving deposits, small time deposits, money market mutual funds, and other few categories. And lastly, M2 also consists everything which is there in M1. So these are the different two types of money, basically demand deposit, saving deposit, M1 and M2. These are the, so we have to keep in mind that at any point of time, if we want to know how much money is there in the economy, then we have to add this M1 and M2. They are basically demand deposit and the currency notes that we have in our hand. These are called M1, and then we have saving deposit, we have small time deposit, we have some investment in mutual market, so on and so forth. Now, before we proceed, I would like to give you an example. Sometimes we buy items by using our credit card. Now, can we say that credit card is also in some form of money? Isn't it? We buy many items using credit card. Is credit card money? The answer is no. Why this is so? Because when I'm using credit card, actually I am not paying anything. Rather, I'm using credit card for deferring the payment. That means I am not able to pay right now, but I am crediting, I am deferring my payment for a future period, And who is paying then? The bank which has issued me the credit card, that bank is actually paying right now to the shopkeeper, and at a later part I have to pay to the bank in the form of the credit card bill. So that is why credit card is actually not money. But what about debit card? Debit card's idea is different. When you have debit card like the ATM card, you can actually access money directly from your account. So that means the money what you have in your account, that balance is attached with that card, which is debit card. So we can consider the debit card as money because debit card represents that balance in your account. Okay, demand deposit, balance in what is there in your account, the deposit. That is why while debit card can be considered as money, credit card cannot be, because credit card is used not to pay but to defer your payment to a future date. And then where is all the currency coming from? So this is case study. In 2001, there was about $580 billion uh, in the US, that is currency outstanding. Okay, so that means $2,734 currency per adult. So who is holding this currency? Okay, who is holding? When I'm saying that in the US this much of money is there, who is holding? So look at this. Currency held abroad. Some people, I am sitting in India, but I am also holding some dollars, right? So that means currency held abroad by foreigners, currency held by illegal entities, right? Not the all money are white, as you might have heard about smugglers, black marketers. So they are also holding some amount of money. These are called illegal entities. Okay, so and then we are actually, so these are basically currency outstanding, that means which are not there in the circulation through proper channel. These are basically outstanding, means they are held by someone else. Then this is called Federal Reserve System. Like in short, it is called Fed, Federal Reserve Bank of the US, and the same concept is applicable in India, and then we call it Reserve Bank of India, which is the central bank. So here we are comparing two things. One is called Federal Reserves in the US, and we have Reserve Bank of India in the in Indian context. So Federal Reserve serves as nation's central bank, and Reserve Bank of India serves as the nation's or India's central bank. Okay, so it is designed to oversee the banking system. Like RBI takes it oversees all the nationalized banks in India. Okay, all the banks are regulated by the Reserve Bank of India, and it regulates the quantity of money. What is the central bank's role? Central bank's role, like RBI is actually Reserve Bank of India or RBI, controls the money supply in the economy. That is why, in which way it controls? RBI can either increase money supply or reduce money supply. What are the ways, that we will discuss later. So for the time being, Federal Reserve Bank or Fed in short regulates quantity of money in the US. Reserve Bank of India controls money supply in India. So Fed was created in 1914 after a series of bank failures convinced Congress that United States need a central bank to ensure the health of the banking system. And this is the structure of Federal Reserve. So same structure is there with our central bank, which is Reserve Bank of India. We have board of governors. Then we have regional federal reserve banks. We have Federal Open Market Committee. So here we have board of governors for RBI. We have regional branches of RBI in Kolkata, Mumbai, Bangalore, Chennai. So we have regional uh, offices of RBI, right? And then we have federal or RBI Open Market Committee. Okay, the same principle. The Fed is run by a board of governors, which has members appointed by president and confirmed by the Senate. Okay, and the most important is the chairman. Chairman directs the Fed staff, presides over board meeting, and testifies the Fed policy. So this is the organization of Federal Reserve Bank, but we have organization of Reserve Bank of India. Within the board of governors, we have representation from the government, and that means uh, they will also have some say on the RBI's decision making. But Reserve Bank of India is basically an autonomous body. We have to keep in mind. So it is not government's property. Reserve Bank of India is autonomous. So if it can generate wealth, then it can give it to the central bank. But we have to remember that the Reserve Bank of India, it is governed by board of governors. Okay, and in that board of governors, there are representatives from the central bank. Sorry, central government. So 7 members, and we will talk about uh, Reserve Bank of India, not the Fed in detail. So we are not discussing this. This is the Federal Reserve Bank system actually. So Federal Reserve Bank was created in the New York implements some Fed's most important decision. So I'm not going to discuss in detail about this because this is applicable in the context of the US. Okay. So this open market committee, it is relevant for the Reserve Bank of India also. So monetary policy, the setting of money supply by policymakers in the central bank, and the money supply refers to the quantity of money available in the economy, and open market committee that regulates the money supply, as I said. So like the Federal Reserve Bank, RBI also has three major rules. It regulates banks to ensure they follow the laws set by Reserve Bank of India to promote safe and sound banking practices, and acts as a banker's bank. That means the nationalized bank, for example, let's say State Bank of India, Punjab National Bank, or let's say Bank of India. These banks actually take can borrow money from RBI. That is why it is called bankers bank. Okay, so they take the money from RBI, and then what we can do that then they give it loans to the common people. So it acts as bankers bank, making loan to banks, and then as a lender of the last resort. Okay, so bankers bank, Reserve Bank gives loan to these nationalized banks, and this nationalized bank then give loans to the public. Okay, that is why RBI, Reserve Bank of India, it is known as bankers bank. Okay, and then conducts monetary policy by controlling money supply. What are the monetary policy? There are different types of monetary policy that we will discuss, but its main role is these three. So all these nationalized banks are regulated by the central bank, which is RBI, time to time. RBI will set different types of rules, norms about the functioning of the nationalized banks, and all the nationalized banks, they are supposed to follow all these norms. It RBI acts as a banker's bank, making loans to banks and as a lender of last resort, and then conduct monetary policy. Okay, there are different types of monetary policy that we'll discuss. This is called open market operations. As I was saying, that how do you control money supply? So money supply is the quantity of money available in the economy, and central banks through open market operation regulates the money. Okay. Now, one way by which central bank operates and controls money supply is through buying and selling government bonds. That is called open market operation. If let's say let's say RBI wants to increase money supply, so what the RBI will do? RBI will issue certain bonds. You might have seen that from time to time. So RBI will issue, sorry, if the RBI wants to reduce money supply, RBI will issue bonds, and then when I am buying bonds, what I am doing, I am paying money to the government, to the RBI, and taking a bond with me. What is bond that we have discussed? Bond is basically a certificate. Okay, let's say the face value of the bond is 10,000 rupees. So I am paying 10,000 from my pocket and I am keeping one bond with me, because the bond is a certificate which will mature and give me some kind of interest. So in that way, when people are buying bonds, what is happening to the money supply? Money supply gets reduced. Okay. So that way, when the RBI is selling bond, money supply will reduce. When RBI is purchasing bond from us, now let's say I want to sell the bond and RBI is purchasing. In that way, I am giving my bond to the bank, and RBI is giving me money, then money supply will increase. So that means this is one way of open market operation, issuing bonds, selling and buying bonds, through which RBI controls money supply. So to increase money supply, Fed or RBI buys government bonds from the public. So when they are buying, money supply will increase. To decrease or to reduce money supply, RBI will sell government bonds to the public. Now, banks can actually influence the quantity of demand deposits in the economy and the money supply. Okay. So, what is the role of banks basically? See, one role we understood in our previous chapter. Banks as a financial intermediaries. Okay, that means as a financial intermediary, bank actually helps the borrower and the savers to exchange their loanable fund. I want to save my money. I will go to the bank and I will deposit my saving. Another person, a household or a firm, wants to borrow money for their investment. They will also come to the bank, and bank will give loan to those people against some interest rate. So that means the borrowers and the savers, they are not directly interacting with each other, rather they are interacting with these banks. In that way, bank acts as a financial intermediary. But bank has another major role in the economy or in the monetary system. Bank can create money. Bank can actually influence the money supply in the economy. So, how the bank creates money in the economy, how the banks regulate the money supply in the economy, that we will discuss in our next session. Thank you.